Hello friends, today is Friday the 13th. It's about 3/4 through the trading day, actually about an hour and a half left to the trading day. And it's a good time to analyze how to look at the market, how to place trades, where to enter trades, and how to analyze the market. And so this is the chart, this is my chart today of the S&P E-mini. This is a 3-minute chart with 5 points between each horizontal line. And first, analyzing the chart, the first thing that we can see when the market first opens is where the market opens and where it closed the previous day. So the market opened here at 43.95, and we can see that the previous day closed 43.80. So there's a potential 15-point gap trade. So that's one way to analyze the market. That's one piece of information to factor in to your trading decisions. Another way to analyze the market is to try to find out or try to determine where the intraday high or low is. And that's important in terms of where the market is going in terms of the candle. If you visualize a candle, a one-day candle, you know that there's a real body and a wick at the top and a wick at the bottom. Usually, not always, but usually there's a wick at the top and a wick at the bottom. And the intraday high is going to be the wick at the top, and the intraday low will be the wick at the bottom if you can spot it. And the way to spot it is to see where and if the high or the low price is taken out. And so let's look at the chart the way it moved. The market opened at 43.95, as I said, but then counterintuitively faded the gap. In other words, moved away from the direction of the gap. The direction of the gap, of course, being down, but the market faded that, moved up. And so the highest point that it reached was at about 10 minutes after the market opened. And that high was about 44.08, okay, 44.08. And then the market retreated. Again, these are 3-minute candles, so each candle is 3 minutes. The market retreated, but then continued its march up and reached a point where it almost took out the previous high. The key being almost. And so the previous high at 950 or 940 at 44.08 is possibly the intraday high based on the fact that it was not taken out when it was tested. And so that's an important consideration. So now we have two considerations. We have the intraday high 44.08, and we have the gap down below at 43.80. So now let's go into the analysis a little more. In order to do that, I use the Taylor trading zone. Now the Taylor trading zone is this green rectangle that I put on my chart. And so this rectangle is marked by bounds of the support at 43.63 and resistance at 44.19. And I get these numbers using the Taylor Trading Technique calculator, and this is what it looks like. The Taylor Trading Technique calculator that is comprised of 12 calculations. And again, the Trading Technique calculator is based on George Taylor's analysis of the markets back in the 1950s, and it's based on averages of averages, movements between highs and lows, highs to highs, lows to lows, and lows to highs. So these are 12 calculations that boil down actually to two numbers, a resistance number and a support number. And that's what I put on my chart. So I draw it out on my chart. I use TradeStation, and it really doesn't matter. Every charting service has the ability to place contents on your chart. And I overlay the Taylor trading zone from 9:30 a.m. to 4 p.m. with the resistance and support numbers. So how do you use this? As you can see, it might not make sense to you, except that you have to know how to use the Taylor trading zone. Because in addition to the exact number of the resistance and support, we have a number that is the difference between the resistance and the support, which is the range of the day. Now, the Taylor trading zone range is a pretty good approximation of the range that the prices will put in for the day. And the prices might not hit the actual resistance or support. Usually they will hit one, very often both, but the 55 in terms of today, Friday the 13th, the 55-point range between these two numbers indicates the range of prices that the market might put in. And in order to use that, in conjunction with the intraday high or low, I take the trading zone and I make a clone of it, and I take the clone and I transpose it down to the intraday, in this case the intraday high, which indicates where the market is likely to end up. If you look at the candle, again, if you look at the wick at the top and the wick at the bottom, well, this is going to be the wick at the top. And right down here, the transposed bottom, based on the range, is going to be the wick at the bottom. So, and as we can see, the prices today, again, this is an hour and a half before the market is set to close. The prices are reaching the wick at the bottom based on the intraday high. And using the intraday high in conjunction with the Taylor trading zone, we have very good information in terms of the market, where the market will end up, where the market is going. Now, of course, the gap was filled today, so trading the gap, depending on where you got on, it had a 15-point range, potential range from where the market opened. A little more if you took the trade at 44.06 or thereabouts. But again, analyzing the market based on the gap, the intraday high or low, in conjunction with the Taylor trading zone, and timing the entries with the stochastics. Now, I use stochastics being the only indicator that I use on my chart, and it's a convenient way of knowing when to enter and exit a trade. And I won't go into that, except to say it's part of the analysis, the due diligence that you should be doing or should be doing as a trader, because it gives you indications of where the market is going, where to limit your trades. So that's how to analyze the trades. At least that's how I analyze the trades. Thank you so much for watching. I'm Marv Eisen from Timeless Dollar Trading Academy. If you'd like more information, you can find it at my site at timelessdollar.com. And trade safely, use lots of patience. Thanks for watching, and I'll see you in my next video.